then we're going to go higher. And so I think this is a short-term pain. We could retest 76,500 in Bitcoin.
If you're sitting here right now and your product is not thinking about how it's trying to benefit from the flows of institutional capital coming into the space, I think you're slightly dead in the water.
Everybody has some type of stablecoin strategy internally that they want to take a shot at, because if you win it, it really is the holy grail.
It's an American thing, and stablecoins are not for Americans. Stablecoins are for everyone else who wants a dollar bank account but can't get one. Americans can get a dollar bank account.
When you see like massive volatility in the market, what is the chain reaction in this mechanism that you described, the risk oracle, and you also mentioned AI?
Are we bullish or bearish on that? Because I've heard conflicting data. Welcome back to The Roll-Up, your home for technical talks and open conversations that shape the modular future. Nothing on today's show is to be construed as financial advice. You can see our full disclosures list at therollup.co/ventures. Sit back, relax, and enjoy today's episode after a quick word from some of our awesome partners.
Ladies, gentlemen, Anons, and Degens, it is stablecoin season, brought to you by your favorite, the best in stablecoins, Frax. USD dollar stablecoin backed by the best in the business, the Biddle Fund by BlackRock and Superstate. This is stablecoin season. It is the yield-bearing stablecoin by Frax, coming soon to a chain near you.
What's going on, guys? Welcome back to The Roll-Up. It's America's Liberation Day. I'm not sure if your portfolio is feeling liberated, but we have here Guy from Ethena, the man who makes centralized stablecoins look like they were from the first era of crypto. We've got Omer protecting your DeFi bags on chain, and Arthur, the guy who makes other investors look normal. Guys, welcome to the show. It's great to have you, Guy. Omer, it's your first time. And how are you guys feeling today on America's Liberation Day?
Rob, yeah.
Not feeling too liberated yet, but hopefully it kicks in later today.
A good man. Well, it's all right, man. At the end of the day, we have a very volatile president. Let's just put it that way. But Omer, Guy, welcome to The Roll-Up. We've had Arthur on once before. We'll love just a brief intro about yourself. Actually, I wasn't on with you, Omer, but Rob was. Maybe we'll start with you, Guy, and what you guys are cooking with Ethena and now Converge as well.
Yeah, for sure. So yeah, my background before Ethena was in TradFi. So I used to work at a hedge fund, spending my time looking at financials mostly. So investing into banks, payments companies, lenders, that kind of stuff. Was involved with crypto back in 2020 and was more of just like a retail speculator on the side through the last cycle, and then decided to make the jump into building this after a piece that Arthur actually put out at the beginning of 2023. So he wrote this blog post called Dust on Crust, and there was a bit of a call for action to say, why he thought this was a big opportunity, where, the reason that the space wanted an asset like this to exist. And, I've been doing the backing behind Athena's product by myself as a thing on the side, and always thought that this could be an interesting thing to turn into a product. And when I read the piece that he put out, it just felt like a bit of a calling when I saw that. So yeah, quit my job after I sort of read that piece, and then put the team together, and we came out about a year ago now, just over a year ago, about 13 months with the initial product. And grew from 0 to just over $6 billion in that year, which is the fastest growing dollar asset that we've ever had in crypto. So yeah, that's our story.
Boy. I also used Notebook LM to listen to a podcast of Arthur's latest piece, BBC, and I was quite excited to be in the bullish camp. But not sure what happened after today's Liberation Day. We've got quite a bit of the macro unfolding. Omer, maybe just a quick kind of introduction to Chaos Labs, what you guys specialize in, and then let's jump right into it.
Yeah. Founded Chaos Labs about 4 years ago. Today, we're the leading risk platform. We have an AI and simulation engine that powers applications like Aave, GMX, Jupiter, EtherFi, Renzo, Venus. So everything from real-time funding rates, interest rates, to liquidation thresholds, liquidation balances, you name it. We probably interacted with some of our products through your favorite applications, and have also the pleasure and privilege of working now with Ethena on a couple of new products, including the Proof of Reserve Oracle.
Sounds great. And Arthur, no introduction necessary. You've been on before, and also we're on with the meme coin messiah, Murad. Maybe you could set the backdrop from a macro perspective. You've written a lot about this recently. You were, in your latest article talking about the fiscal domination of the Fed, of the office and the administration now over Powell and the Fed, and was also arguing that tariffs didn't really matter in the crypto markets, at least as much as in the stock markets. So after kind of seeing things unfold today, how has your thesis changed at all, or generally how are you seeing the macro backdrop of things these days?
Yeah, so I don't really think my thesis has changed. Obviously, I'm looking at my charts right now. Bitcoin was like what 89,000, now it's like 82,000 something and change. Obviously, it's a reaction to these across the board tariffs. So I was speaking to some of my friends in the TradFi world, and it's like, what was the expectation on the street for these tariffs? And there really wasn't one specific number that anyone was looking for, but it sounds like whatever Trump and the administration rolled out is probably worse than the worst case of what people thought would happen in terms of these tariffs. And obviously, we're seeing that reflected in the markets. But I think the good thing with crypto and Bitcoin at the end of the day is it's a very simple equation. All we care about is, are there more fiat dollars, yen, euros, pounds in the world than yesterday? If so, then we're going to go higher. And so I think this is a short-term pain. We could retest 76,500 in Bitcoin, and we'll see what happens at that level. Even if it breaks, I'm still buying stuff. So I think this is a great opportunity to buy things. At the end of the day, every central bank is going to be printing because they believe that they need to offset the negative effects of these tariffs, whether it's inflationary and some companies are doing badly in America, or you're in Europe and you have a company that no longer can sell as many goods and whatever. It's just an excuse for the central banks and the finance ministries to print more money. And they're already telling us in not so many words, and Bloomberg and other relevant publications, that these tariffs are very negative. Therefore, we need to provide some sort of accommodation to our economy. So I expect to see a lot more fiscal and monetary accommodation from every single country around the world as they try to fight back against these tariffs that Trump has put on different nations.
Yeah, I mean, I, for one, was kind of brought into light that the U.S. has just accepted tariffs kind of begrudgingly for the last, few decades, from, every country that Trump had on his list today as kind of this form of soft power, the extension of the USD as a global reserve currency. And so there's been a lot of differing opinions. Passing it over to you, Guy, curious from the stablecoin perspective, specifically about the rates. How do you think about the potential for lower interest rates over the next 6 to 9 months? I think Goldman has predicted 3 cuts. How do you think about that affecting the stablecoin atmosphere, Athena's business model, how you see that playing out for crypto?
Yeah, I think it has an interesting effect that works in both ways, right? Which is like generally when rates go down, speculation in crypto picks up and demand for dollars within crypto pick up as well. So it was an interesting dynamic last cycle when rates went to zero, but we added like $100 billion of stablecoin supply. There is a bit of an offsetting factor that works in both directions there. The one piece I would say that Ethena looks very different to something like a Circle is that actually the rates within Athena's product tend to actually exhibit like negative correlation to real rates in the real world, which is probably the most powerful quality of Athena. And it's for the same reason that I just outlined there, which is when rates are going down, people are speculating on shitcoins more and then demanding more leverage within crypto to do that. And so if you really think about it, like Ethena existed at pretty much the worst moment in the last 10 years from a rate perspective to have even come to market when we were fighting a hurdle rate that was at the highs for the last 20 years. And actually, when you see rates come down, like we saw in Q4 of last year, rates came down by roughly 75 bips, and funding rates went up by roughly 14% on average for the quarter. So that's actually like the moment that Ethena shines, which is Circle's going to be losing $400 million of revenue a year for every 100 basis points that interest rates come down. And I actually think the rates on Athena's product are going to go up with the demand expansion for stablecoins, and then the hurdle rates going down. So I think we're pretty excited for that moment. And if 3 rate cuts are coming, then I'm going to be pretty happy about that. Yeah.
So I guess you're not buying the Circle IPO then.
I was wondering the same thing. Are we bullish or bearish on that? Because I've heard conflicting data.
I was pretty shocked by the numbers personally. There's a good graph. There's this trader called John Brown, I think his name is. People think it's maybe a Paolo alt account. And he just put a graph side by side of sort of the supply, but then the profitability of Tether versus Circle. And Tether's at like 14 billion this year, and Circle's at 100 and something. So even though the supplies are like, not too far off, it's like roughly just below half. The profitability is like literally an order of magnitude different, which is quite crazy.
Yeah, so I think Circle has a distribution problem, and it's a very American-focused product. And Americans don't need a dollar stablecoin. They have Venmo and Cash App and all these other things, and they have the fucking dollar, right? It's everyone else around the world who needs a dollar bank account. And that's what Tether is. Tether is strong in China and emerging Asia and these sorts of places. It's not very strong in America. Obviously, Circle is an American company, and it's partnered with Coinbase to distribute their product essentially. And Coinbase, to generate users, needs to give away yield because they need to compete with Tether, who has a better distribution network but doesn't give away yield. So the reason why Circle has to give away yield is that's how they get clients. And so they basically pass on a lot of their NIM to Coinbase, who then passes it on to people who hold Circle with them in custody revenue. And so basically that's why Circle's fucked. And I think at some point Coinbase just buys Circle, and they're just going to wait for their right opportune moment where the price is cheap enough to do it. And so that's why I think this IPO is a piece of shit, because again, Circle has no distribution. It's purely against Coinbase, and they have no defensibility on their net interest margin, unlike Tether, and they're predominantly for Americans, which already has a dollar. So I think it's not really the strongest use case for a stablecoin, and that's why I think Tether, if you want to talk about a dollar-backed stablecoin in a bank account, is a vastly superior product and will continue to kick their ass.
Omer, anything to add there?
I just think generally, like what we're seeing is that the stablecoin market, and not only by supply but also utility in all of the applications that we work with, the landscape is changing really quickly. I think like one of the things that's shocking to hear is that Ethena and Guy has only been 13 months. It feels like much longer. And you're seeing a lot of kind of stable coins that previously were the holy grail in terms of distribution, liquidity, and utility. You're seeing that market share change way quicker than I think anybody anticipated. So I think it's even more so the case. People need to continue innovating, finding the better use cases and how to kind of drive that and put that in the user's hands. And the Circle S1 is interesting, and I think it's also an opportunity for them to continue pushing the frontier and try new things.
I guess quick follow up on the business model, and also tying this into macros, that one potential fallout of these tariffs is that we get massive inflation, and if we don't couple that with like cutting rates, maybe they do cut rates, and this kind of kicks them in the ass to do so. But there's one theory that says like there's more pain that's necessary, and like longer term treasury rates could go up. And so I guess maybe Arthur, from your side, like what do you think the probability of something like that happening is? And then if that does happen, Guy, how do you guys react on the Ethena side if you do see, treasury rates increase significantly?
Well, I think Powell already told us what the Fed's baseline view is, and he got asked, what do you think about tariffs? And he said, we think any inflationary impact of tariffs is transitory. So that already says he's going to ease, even if, inflation's 4, 5, 6, whatever percent it goes to because of higher import costs in America. He believes that's a short-term impact. Therefore, he doesn't have to adjust his bias towards easing monetary conditions. So they've already said they're not even going to look at them, I think. And the fact that he even used the word transitory after he got torched so bad in 2022 when he said inflation is transitory and then went to 40-year highs, I think tells you how entrenched their view is that they want to ease rates. And if Treasury bills and notes and bonds start falling, yields start rising, then that's even more reason why they need to end the supplemental leverage ratio for banks. And the Fed needs to start doing QE for treasuries, because the US government cannot afford 4.5%, 5.5% yield on the 10-year treasury when you have a $36 trillion and rising exponentially debt pile.
Yeah, and I think from our side, we had the growth that we had last year, despite the fact that rates were like 75 basis points higher than where they are now. So if they went up a bit or stayed where they are now, I'd feel comfortable that we could continue growing, maybe just not quite at the pace that I'd hope we can if rates were going down. I think the other pieces that we have added a piece to the product within the last 6 months, which I think gives us a bit of flexibility, which is this USD TV product, which you might have seen. So that's just a simple wrapper around the BlackRock BUIDL, and Ethena now is the largest holder of BUIDL in crypto. So it's like roughly 70% of the BUIDL product is held within our sort of like vanilla stablecoin. The cool thing about that is it almost gives you flexibility within the rate cycle to just say, what proportion of these two things do I want to fill USD with? And so in a moment like now, when rates are extremely depressed across the market, so funding right now is actually at the lows that it's been for almost like 18 months. You have the option to just go back into something that looks and feels a little bit like a normal yield-bearing T-bill backed stablecoin, essentially. And so, yeah, we always have the flexibility to sort of like match the rest of the market when they're using that. It's just you have the like embedded option there where if crypto rates go up, USD is like the best position to sort of capture that piece as well. Yeah.
It seems like it's pretty clear that if the rates come down and we get more speculation as a result, Ethena is very, very strongly positioned in the entire stablecoin landscape by design. Is that fair?
Yeah.
Like, what am I missing there? It seems too obvious.
Yeah, I'd say it's like a painfully reflexive like project because it goes through these wild swings, especially on even like the growth profile. Like if you looked at the growth profile of USDE, it goes up in like a vertical line, like 3 billion, and then it sort of flatlines for a few months, and then rates come back and it goes up by like 4 bill. And it's a slightly strange growth profile, which isn't sort of steadily kicking up. It just has these really aggressive peaks and sort of like flattening periods. But yeah, I think you're right. It's almost by design one of the most like reflexive assets out there. And I think even the growth that we had in Q4 of last year, we weren't really integrated in many places. We really only had like centralized exchange listings on Bybit, and we've added like 4 centralized exchanges since then. We worked with Omer on the Aave piece where, you know, listing USD there's a very interesting like levered looping strategy that people were doing at huge size. But unfortunately, Omer was holding us back and was sort of like capping us as we went to keep it safe. And so, I mean, that market I think could have got to like 3 to 5 billion, and we did it in a safe and responsible way, working with Omer, and sort of took that to 1.5. But yeah, I guess the reason I'm giving this context is that when I think the market does come back now, we've sort of set ourselves up in a bunch of different areas now where it can, I think, grow even faster than it was before. Yeah.
Yeah, and I just also think we're better positioned because at the time, Aave, like most of the industry, was still doing everything manually in terms of the updates. Today, we have the risk oracles, so we can react in real time or in much higher frequencies and cadences than we ever could before. So this allows us to kind of capture opportunity when it presents itself, but also wind things down and be more secure and risk off when we need to. And I think that was one of the main kind of limiting factors last cycle, that we always had to prepare for the worst possible scenario, because it would take us at least a week to make any change across Aave specifically, but every other protocol. And since launching Edge with Aave, I think soon we're going to have the PT markets. We're able to be more flexible on the core Ethena markets, and then same goes for the derivative markets on chain too.
Omer, when you see like massive volatility in the market, what is the chain reaction in this mechanism that you described, the risk oracle, and you also mentioned AI is utilized in that mechanism? What does that chain reaction look like when you see volatility?
Yeah, so I think there's a few things. So first, like setting the stage and how AI even is a part of this. I think early when we started the business, all of our risk models were powered primarily by quantitative signals. So we're looking at volume, price action, liquidity, depth, all these things across different markets. But oftentimes the vast majority of the time, the driver to all of this type of price action and volatility in the market is news itself. And when news breaks, now we can react to it much faster, right? So if we're already on the topic of stablecoins, I think like the canonical example is the USDC DPEG. We're also speaking earlier about Circle that happened when SVB collapsed. The number one thing that you saw, or like immediately, was everyone dumping all of their USDC into Aave and withdrawing USDT. There was uncertainty around the time around the stability of the peg and whether or not they'd be able to make everybody whole. And it's exactly these type of black swan events that as a risk manager, you always need to take into consideration, even if it's the tail, because our responsibility is ultimately to kind of protect the users and keep the protocol solvent. So 2 years ago, we realized that going through governance for every single parameter was not what the future looked like. And that's why we built Edge, the Oracle protocol. And during times like this, it's when it really shines. So to kind of guy in Arthur's earlier point, you have the tariffs that Trump's announced today, interest rates going down, speculation increases, which is also followed by volatility and all of these kind of mid to small market cap tokens. And in absence of being able to have kind of secure real-time infrastructure, you just kind of need to be extremely, extremely conservative and shut down business for a lot of these applications. So Edge is not just about security for Aave, for GMX, for Jupiter. It also lets them be more lenient and capture opportunity, capture flow, capture volume and fees. Whereas before there just wasn't an option because it was compromising security.
And Guy, I can only assume that this has been highly impactful in terms of your risk strategy when thinking about how to design something very resilient and sustainable. You guys have made this announcement around Converge, which had quite a bit of attention, especially around Trump's World Liberty Fi and this kind of big institutional push from New York and DC. Before we get into Converge, what is the state of Ethena's relationships in DC, in New York, with institutions and regulators? And what's kind of happening on the ground floor there with regards to World Liberty Fi and any of the stablecoin, Oracle, kind of DeFi projects that are getting kind of in bed with some of these institutions and regulators?
Yeah, I think we're spending slightly less time, I'd say, with regulators in the US and more focused really on like accredited and professional institutions who are sitting there. So I think the macro view that I have, and I'm interested in you guys if you guys share the same view, is that this cycle we've actually really seen barely any inflows outside of BTC ETFs, and then Tether going up a little bit in supply. Like if you look at DeFi TVL, we've really just reshuffled the same chips between each other and like taking some from Ethereum, throwing it on Solana, taking some from Solana, throwing it on Parachain. And there hasn't actually really been like real inflows that have come into the space, specifically with like on-chain products. The view that we had is that Ethena's product is actually like uniquely interesting to people within TradFi, because if you take something that's got close to zero volatility and like an 18% annualized return, the demand for that in TradFi isn't like $5 billion. It's like a few $100 billion. And I think we saw that a little bit with Terra last cycle, which obviously didn't turn out in the right way. But actually, the learning from that was actually a dollar which can produce a structurally higher return is kind of a product that can appeal to everyone on earth, whether you're a retail individual in Southeast Asia or like a BlackRock sitting in New York. So the view that we have is that they're like here right now and they're thinking, what are we doing after ETFs? And, a lot of these institutions have hired 30, 50-man teams who are sitting there and saying, what are we doing next after putting up an ETF? You've obviously got the on-chain treasury products that they're bringing on-chain, and we're obviously interacting with those in that normal stablecoin that I described. But I think the bigger opportunity here is actually asking ourselves the question to say, what primitives or uniquely interesting like products coming out of crypto can we actually export out into TradFi rather than us like consuming their products? And we're basically coming out with this product called iUSDE, which I shared some thoughts on like a couple of months ago in our roadmap. And really, it's just like a tokenized security of USDE, which has just got basic KYC and permissioning that sits around it. And it just puts it in a format that you can actually export out into TradFi. So within the next, call it like 10 days, we're going to be announcing the first distribution partner that we're coming out with on that product. And they're seeding this with like $500 million of their funds, which is obviously a reasonably chunky ticket to come in to start this whole thing.
Don't fuck it up.
And I think it just gives you a sense of the scale of how big that can get in the right conditions, which is, and if you set up the rails in the right way. So that's sort of like the theme that we're looking at. And I think if you're sitting here right now and your product is not thinking about how it's trying to benefit from the flows of institutional capital coming into the space, I think you're slightly dead in the water. Like if you're just focused on like, again, shuffling those same chips around within DeFi. And we just think we're in a reasonable position to actually provide a pretty interesting product to them. So, yeah.
Yeah, I mean, on that point, Arthur, are you a little bit worried that some of these institutions are going to come in and take your lunch as the guy who's been running circles around the rest of the crypto market for the last couple of years? Like, are these guys going to make it more efficient, more mature, harder to kind of do basis trading, or kind of what's your perception on balancing this new capital with the sophistication that's going to come in and potentially deteriorate your edge, our edge, and those who aren't as deep in terms of pockets or in terms of personnel?
I mean, I think at the end of the day, it's still a cover your ass mentality at any sort of institution. And so you had sort of a replay of that with the Bybit fiasco and hack. You know, they lost $1.5 billion. Thankfully, Ben is a rich motherfucker, so he just reached into his pocket and paid it out. But if you're sitting as a risk manager at some, US or Western European hedge fund, and you're running a basis trade and you've got exposure to this exchange that's all the way in spooky Asia, you're going to be fucking shitting your pants, because the last thing that you want to have, you convinced your boss to let you do this sort of crypto basis trade thing. Then some motherfucker that you've never heard of before just puked $1.5 billion, and you're shitting your pants worrying if you're going to be able to afford your Hamptons house because this guy's not going to pay you back. And so I think that just highlights that these guys are really only going to trade on a very few select venues. And so, yeah, maybe the basis on the CME and some, lit TradFi exchanges or Coinbase or something like that, that sort of opportunity compresses, but there's going to be an immense opportunity between, worldwide dexes, exchanges that are not based in Western Europe and America, and the price discovery that basically all of retail does in crypto versus the places where TradFi feels comfortable with trading. And I think there's going to be even more opportunities to sort of arbitrage the differences between those. And it's going to be even more fun to trade crypto because you're going to have a lot more liquidity to put on two-legged trades in this ecosystem. So I'm actually excited because of the myopia of how Western investors think and what they're scared of, we're going to have even more opportunity to make more money off of them, I think.
Yeah, and I think just to maybe add to Arthur's comment, I think there is definitely a spectrum of how willing different types of institutions are to like step into things. And I think the point that Arthur was making there around CME versus like crypto native venues is actually the perfect comparison here, because if you even just look at the basis on CME versus like a Binance, there's like roughly a 700 basis points difference in the last year, which just shows you how much people don't want to actually go and take that credit risk. But there is a spectrum between a sleepy asset manager who's managing $10 trillion and then a hedge fund who's managing a few billion, and they're like, I understand the risk that I'm underwriting and I want to actually take that credit risk to get paid for it. So I think that there is like a bit of a spectrum there, and it's not going to be, the absolute largest, slowest moving people who come in and do that first. And I think just to your other comment around, are we sort of like concerned that more money coming in reduces the inefficiency, reduces the interest rates, whatever it is? I think that's just like an outcome that is natural in any market that's sort of like maturing and growing up. And I don't think the correct response function to there's an inefficiency in the market, someone is going to close it. The correct response is not to like ignore it. It's to say like, how the fuck can I profit from that inefficiency being closed, right? And that's all Ethena is actually doing, which is saying you're getting paid too much to put on an unlevered cash and carry within crypto. And that number should not be 18% annualized. It should be something that's below 10, I think. And someone is actually going to shove billions of dollars of supply into that, and hopefully you can create some value along the way. And that's kind of the view that we have, is it is going to close, but we want to be the vehicle through which that actually happens, if that makes sense.
I just want to add to that from like a different perspective. I think to echo both Arthur and Guy, still like having agency and the ability to take risk as an individual trader is still something that's overlooked and big. But I also think that one big difference in this cycle is that it's true that there are more sophisticated players that are coming on chain. But today, with the recent advances in AI and products that are coming to market, I think the average Joe and traders have access to information in real time that previously they didn't. So this doesn't apply to every single trade, but it applies to many. And then I think if there is, for some of these trades, symmetry in terms of the information, then it again boils down to the risk and are you willing to make the move? So I still think there's a lot of opportunity in these markets. And I think that's something that we're going to see more and more as we look at this cycle.
Yeah. Follow up on that, and just how we're looking at risk in this market. Arthur, I think you're the most recent recipient of a pardon from Trump, but you still describe yourself, I think, as like an Eastern, like with an Eastern Hemisphere mindset when it comes to trading in the markets. How, what is the difference between someone that carries a Western philosophy versus an Eastern philosophy, and how do these differ when they approach risk in the market?
I think it comes down to how institutionalized the framework is. So if you think about capital formation, it's it's mostly a United States thing and a little bit of Western Europe. If you think of the largest, most successful hedge funds in the history of modern finance, they're all from the United States. And sort of everyone over here sort of apes, Rentec and Millennium and Point72 and all these sorts of guys, right? But at the end of the day, once you start into that sort of Western mindset and you have pension funds and public endowments and these sorts of people as your investors, you can't go to them and say, oh yeah, I traded on this funky commodities market in Dalian and I just lost $1 billion of your money. Like, what the fuck are you doing? Why aren't you trading in New York? It's a liquid, most deepest market in the world. It's the best of whatever, right? So I think the bigger you get, the more constrained you get and the sort of the opportunities that you can take. And your investors are really investing in, I want a low volatility, 7 to 12% return a year. That's what Izzy gives you at Millennium. And he has, I don't know, however many tens of billions of dollars under management. It's one of the most successful hedge funds ever. That's all you need to do. Low volatility, 7 to 15%, and you're crushing it, right? And so why would you go into crypto and risk your career when you could be making $50 a year trading some, bullshit long short strategy? You're not. And so I think that's what prevents a lot of these large Western institutions from coming into crypto, is because the career risk and the fact that they have to stand up to their investors and justify why they just lost $100 million, $1 billion because something funky happened somewhere they're not really familiar with. They're just going to go with the safe thing, the liquid market. They know these trades. It's easy, right? And so I think that's one of the thing that Guy is trying to bring these products with. Hey, I'm going to make this very simple for you. Here's a trade you understand. Low vol, I'll give you 15%. Do you like this trade? Here are the risks. Here's how I've mitigated them. It's very documented. It fits within your framework. Do you want to get involved or not? Versus, hey, I've got this like latency arbitrage between DEXs and SEXs. And guess what? If an exchange goes down, yeah, I could lose 30% of my capital. But yeah, I'm making 30, 40, 50% a year. It's too volatile for these guys. And so I think it's just a function of the success and deepness of the markets, in that the investors just don't want to take that risk. And therefore the fiduciaries managing it aren't going to take those risks, which is great for us as crypto individuals and sort of non-multi-billion dollar hedge funds, in that we have all these opportunities in all these markets around the world to really generate significant alpha for ourselves, because the big guys just can't do it from a reputational perspective.
Yeah, slightly off kind of tangent. Did you take time with Trump and like have to go through a whole process to get a pardon? What happened?
No, I didn't. I can't really get in details, but no, I didn't speak with Trump. It's a very standard process of how this sort of works. And yeah, we submitted our paperwork, and we got very lucky, and thankfully the administration granted myself, my partners, and the company a pardon. But there's nothing that funky about it.
Okay. Won't dig any deeper. All right, guys, let's talk about Converge. I think this was the really, really cool announcement that was dropped, I think about 2 weeks ago. Guy, you guys pioneered this idea of SUSDE and Ethena about, as you said, about a year ago, really hit the market hard. A lot of this, not within your own, what they call execution environment, right? Operating within a different, within Ethereum, and having to kind of go through the trials and tribulations of that. We have quite a strong thesis here on the roll-up with regards to purpose-built chains for specific use cases, technically architecting chains for specific design and purpose, whether they're app chains or single app or multi-app or niche, very specific choices. And it's hard to do that when you're operating on a general purpose infrastructure. Then you have the noisy neighbor problem. You have gas fees. You have user experience problems. There's just a lot of things that you can't customize. And I think customization is one of the big factors when it comes to launching your own chain. Now, on top of that, when you guys were kind of architecting why this was what you wanted to do, the thesis was very simple. It was like, the biggest opportunity here is institutions are coming on chain. We believe that there's effectively a barbell approach, which I had a really good pod with Paul from Plasma and also Akshat. And we spoke about this, where it's very clear. It's speculation, 24/7 casino, DeFi gambling. It's meme coins. It's everything that you can do on chain right now. It's 8 p.m. here in Brazil. And then it's stablecoins, settlement. It's this payments. It's kind of that infrastructure. And so you guys have partnered with Securitize, which seems to be everywhere right now, and absolutely making a massive dent in the space. So maybe before we get into the kind of nitty gritty of how it works on the tech side and why Walk us through the decision-making process here, because some of the Ethereum maxi people were like, oh, they're ditching Ethereum and here's another vampire attack. And so walk us through your mental framework in the last 3 to 6 months as to why you guys chose this, and just like the chronological story of how it all came about.
Innovating finance, global, institutional, and on-chain. Deep liquidity to drive capital efficiency. Now, maximize yields on institutional-grade liquid staking with METH. Unlock $1 trillion of capital via Bitcoin. All of this secured by Mantle's treasury of billions in stables and ETH capital pools. This entire ecosystem is coordinated by a vast network of seasoned VCs that are aiming to create the next generation of banking and financial technology. This is Mantle. RedStone is DeFi's modular oracle, supporting over 100 clients on over 50 chains and offering 1,000 assets. RedStone is the leader for Bitcoin staking and yield-bearing assets. They offer the most robust, customizable price feeds available in any model. Join the RedStone exhibition today.
Yeah, for sure. I think at a macro level, I think the point you're getting to earlier is actually where we started with this, which was, I think you're right that there's only two real use cases now for crypto and like why blockchains exist. You've got the speculation, which is basically meme coins on Solana or leverage on Hyperliquid. And then you've got settlement for dollars and tokenized assets. And so Ethereum has kind of like lost that first use case. And I think it's very difficult to argue against that right now, which all speculation has basically moved off onto some other chain, whether it's Solana or something else. And then it is still dominant when it comes to stablecoins. And that's obviously where Ethena started. And then tokenized assets as well. It's where the institutions have come initially to start. The piece that I'm really trying to challenge here is actually that if you think about what's left in the narrative for ETH, it's that institutions are coming to build here, but it's a pretty weak argument, which is they started here, but if you've noticed, they take their assets and they bring it everywhere else. So it goes to Solana like the week after, like there was something in the news just last week around Biddle going over there. And what people don't understand is that it really has nothing to do with like Ethereum being particularly special around that. It's really a decision that's driven by the stablecoin issuers and the tokenization issuers. It's actually us who decides where this goes. And I think the really interesting position that Securitize is in the market is that they're obviously the chosen tokenization partner for BlackRock, and there's ambitions to do a lot more than just bringing treasuries on chain. It's basically every single asset that exists on Earth, can we bring it on chain and actually start to build financial infrastructure around it? And so we just saw a very interesting matchup here, which was you have what we think is a uniquely compelling product for TradFi, which is this iUSDE piece that I was describing to you earlier. You've got you've got an entity with Ethena that knows how to build an DeFi ecosystem around itself. All of the stuff that we've done on ETH-L1 in the last year, I think, was potentially one of the most impactful things that happened on ETH-L1 in the last sort of 12 to 18 months. And we basically just want to capture that value by bringing it into our own environment, but then actually making a purpose-built where Securitize can bring TradFi and institutional flows to come on chain. I think the really interesting thing here is that you've actually got like two different directions of flows where Ethena is really bringing crypto native assets and primitives, wrapping them up in a format and then pushing them out into TradFi to be consumed there, which obviously brings inflows into crypto. But then Securitize is bringing TradFi related assets and bringing them on chain to say, what else can we do with these going forward? And the design space starts to like open up quite a bit when you start to think about things like, Arthur created the first, popular perps exchange that existed out there. I don't think it makes sense that retail users are trading options on single name equities on Robinhood. I think that market should move to perps, and that's like the logical end state of where that should go. And there's a lot of these different questions of like, what are we doing with like TradFi assets, but thinking about how we put them within sort of crypto primitives. And I think that idea around like perps on equities is an extremely interesting one that someone's going to do very well in the next couple of years. So anyway, that's the high level view. We think this is like the biggest opportunity this cycle and next, which is how are you bringing institutional flows on chain? And we've just got a very uniquely positioned business between Ethena and Securitize, which is kind of like leading between stablecoins and tokenization. And those two use cases that I described to you, if you really believe the crypto thesis, you kind of believe actually that the speculation one should become much smaller and much less significant than bringing every asset on earth on chain, right? So like right now, speculation is the core use of everything that we're doing. But if you really believe in the long distance of what we're doing here, you'd like to think that stablecoins and tokenized assets become a much larger piece of the market going forward. And we just think that there's less competition, and it's a uniquely large opportunity for us to go and grab. Yeah.
Arthur, do you think this is going to be the institutional chain? Is this the place where institutions will come to go on chain?
I hope so. My bags will greatly appreciate it. But I guess at the end of the day, we don't know.
Shorts then?
We don't know where they're going to go. And I think it's a fool's errand to try to predict like how this sort of evolves. But I do believe that Larry Fink wants to tokenize everything, but I don't think that he likes that are his distribution method and his trading method for his products. He would like to control that flow and take all that revenue that the exchanges, TradFi exchanges make, and bring that into BlackRock, or completely disintermediate them altogether, and they don't exist anymore. So I think, if Guy and others' visions and their products are really successful, there should be no more TradFi exchanges. They should all go to zero. And I hope they all go to zero. And that all of this is brought on chain into the crypto or blockchain enabled space. Because if we have the internet, if everyone has a computer, why are we shuffling around pieces of paper in Hoboken in New Jersey and have all these internet connected servers and all over the world in these TradFi exchanges when we have all this great infrastructure that we're building, hopefully decentralized across the world? And I think that's what ultimately asset managers like BlackRock are going to do, because as much as they love the artifice of TradFi, they also want to get rid of people that they're paying fees to. Especially these exchanges that sort of are the gatekeepers between trading volumes and distribution of their products. They literally can own their own DEX, spin it up. And now BlackRock has complete control, vertical integration over origination all the way to trading of their products. And I think that's what really is the driver here for an asset manager like BlackRock. And hopefully we can invest in the technology that's going to power that and own the tokens of the protocols. We could invest in the technology that's going to power that and own the tokens of the protocols that are enabling them to disintermediate their competitors within the TradFi space.
I also think I'll just add that, I think we assume that they're a lot more opinionated than they are, right? These are businesses that are just trying to sell products. Like BlackRock is coming here with the treasury product and they're saying, who wants this? And if you want to buy it on Solana, cool, they'll deliver it to you at Solana and they'll bring it to Avalanche and they'll bring it everywhere. They're just selling us products, right? And so we've also got to remember that they're completely centralized products, right? And so if something goes wrong on some chain, they're not actually worried about the decentralization of ETH because it's a completely centralized product that they'll reissue somewhere else. It's a completely different proposition, though, where if BlackRock is putting their own money and their own balance sheet into a crypto native product, they really care about where that money's sitting, because if they can't roll things back, if there isn't controls around OFAC, sanctions, North Koreans, all of these different pieces, it's a very different proposition when it's their money versus them trying to sell you a product. And so the existing landscape of the assets that sit out there now and what these institutions are doing on chain, all they're doing is selling you products. And so I don't think they could care couldn't care less basically where it is. And really the decision is going to be made, as I said, by the people who are creating the products and the issuers of these assets. And so when Ethena turns around and says the $1.5 billion of BUIDL that we hold in our backing, we're going to hold it on our own chain, we don't care what anyone else has to think about that. That's our decision to make in terms of where we're housing those assets. And so that's just the piece that I'm trying to get across, which is A, I don't think they care on their side. They're just selling products. And B, it's like apps and issuers and stablecoins that basically make that decision.
I think something else that we're going to see with the emergence of these Converge, I hope, and some of these other L2s and stablecoin environments is that we haven't really, for the past decade, we haven't really seen any super significant innovation in fintech due to the rails that it's built on. So if you look at all the startups that are kind of big in the fintech space, they're just kind of putting better wrappers on very shitty infrastructure. But over the past, I would say 3 years, stablecoin infrastructure has exploded for most, even if you're in America, you can connect these easily to your bank account and move in and out of these different chains. And that actually opens up the door for a ton of new consumer experiences that are not just directly related to speculation on crypto. So just as an example, a smarter savings account, right? You could definitely build that today and you couldn't do that 3 years ago. And Converge is definitely going to be a good candidate for that, but you can do it on any chain, and that's actually huge. So I think this is also the first cycle where we don't really have many good excuses to not build real products that build people on board that are outside of the tribe of super diehard core believers, just people that want better products and don't really kind of live or breathe the decentralization ethos of it. They want just better alternatives.
I think the market agrees with that. And like there was an announcement today about a new app chain that DTCC, the clearinghouse, is just now thinking about and announcing that's going to increase the mobility and velocity of collateral, increase capital efficiencies and liquidities, and facilitate the convergence of traditional digital assets. You know, you guys kind of beat them to the punch. This is a clearinghouse that does on the scale of $3 quadrillion of volume in settlement. And they're also going in this direction. You guys just kind of did it first. And so I don't know if you've seen the announcement, kind of what you think about it, but just generally, if this seems like a competitor to you guys, and this TAM is massive on the order of quadrillions of dollars.
Yeah, I think you're right. Directionally going in the same place. I do think that like it's going to look slightly different. I think the optimal setup here is still like yet to be defined, but something that looks like a permissionless blockchain that anyone can come on and interact with. Like I think at a very basic level, it can't be totally permissioned, or else like what are we actually doing here? But I think even if you think about the sequencer that's sitting on something like Base, right? In some respects, that's actually a completely permissioned blockchain, because if the sequencer on Base doesn't want your transaction to go through, then it's not going through, and that's like a single entity that's deciding whether that goes through. One idea that we're sort of playing with here, and we're sort of defining what that actually looks like, is what if you have an environment that looks like Base, but there's some validation of that sequencer between maybe 10 or 20 parties, and that those 10 parties could be the 10 largest asset managers on earth and a few centralized exchanges, or whatever those parties are. And all you're trying to put in there is basically saying, if there is a $1.5 billion hack, again, from a North Korean, and it's BlackRock's money this time, can you actually roll that back on the sequencer in a circumstance where you know that clearly, like, this is something that you don't want to go through? And so I think this is the piece that we're trying to toy with a bit here, which is, you know, purists and idealists don't like this idea at all, that you even have the option to do something like that. But I think if you peel back the layers of what actually exists within the space right now, and we're actually honest with ourselves, these kind of assumptions sit everywhere, like the single sequences on all of the L2s right now. And I think we're just trying to find a pragmatic middle ground, which is these things can be open, they can be permissionless for people to interact with, unless it's like really a criminal act that is like stealing other people's money. And then I think you'd want some sort of like switch to be able to get in there and roll it back.
I think that's the beauty of building a chain. It's funny, like you've built the app that's done so well, and now you have to think about infrastructure, but you have a lot of options now. And I think part of leaving L1 and kind of launching your own chain is to build that exactly what you're saying, because it fits your use case. There will be other extremely permissionless, fully decentralized, censorship resistant environments. And that's great. Maybe you would want to hold some of your long-term capital there. Like Bitcoin's a great example, right? But like you guys aren't trying to build Bitcoin or Ethereum L1. You're trying to build a specific idea with a specific custom technical design. So I see it as like, you know, kind of like fuck with the people who are worried about, you know, kind of some level of censorship resistance or decentralization in the state of like, if it seems like what you guys are going to achieve is a permissioned level and a permissionless, some sort of like bifurcation there. And it seems like kind of both parts will have a different way of managing risk and rollbacks.
Yeah, I think that's right. And the other thing I'd just like encourage people to think about is like, we're obsessed with this idea of decentralization, but like, should we actually like pause and think about what we're doing on chain? Like we're moving centralized stablecoins around and we're trading meme coins. Like those aren't things that are like require nation state level of decentralization, right? Like I think a server with like 10 validators is kind of like sufficient for both of those use cases. So I think that there is this like obsession with pure decentralization the entire time. But if you look at all of the products that have actually done well this cycle, right, you had Hyperliquid, which like looks and feels like a centralized exchange based on what you've seen like last week. You had Ethena, which is, you know, touching centralized exchanges the entire time and centralized custodians. And then Pump Fun, which is again like a centralized exchange that settles on chain. And so all of these things, like I think the market is consistently telling you it's willing to make these trade-offs for decentralization to get better products. And that's just what you should be focused on, which is producing a better product in the beginning.
Plus, if you guys have 10 contributors to the sequencing logic, you're still more decentralized than most of the popular L2s that are out there now.
Yeah.
Kind of zooming out of Converge and back into the broader state of stablecoins, crypto, and speculation. Kind of really zooming out to just where we are. Arthur, I was on a pod with Akshat 2 months ago or so in Hong Kong, and he said that you guys were gearing up for the Trump dump, and that it came, and that you guys were actively kind of slowly trimming positions, ready for that in anticipation. And then kind of in the recent article, you wrote about how you were reallocating to the space. What does this mean for the market, but also just the general trajectory of where we're going? Is it the institutions that has gotten you reinterested? Is it the macro? What is it that has kind of triggered you to want to reallocate, and where do we go from here?
I mean, it's very simple. As I said in the intro, it's fiat liquidity. I was skeptical that the fiat liquidity emissions would meet the expectations between obviously Trump election and January 20th when he assumed office. And now the market doesn't think they're going to print any money, which I think is the opposite end of the spectrum. And so now we've seen noise out of the Fed that I believe they're going to start QE sometime this year, or at least in the treasury market. You have the Europeans who are going to print euros to build weapons. The Chinese are waiting for the Americans to print, and they're going to print more money. And the BOJ is cornered, and I bet they're going to go back to buying bonds when the JGB market falls apart in the near future. So I think it's just the ebb and flow of expectations and the pace of money printing, which has gotten me more bullish, and obviously Maelstrom as a whole allocating more to the space. And right now I'm mostly just buying Bitcoin at the end of the day, right? I think, and you see Bitcoin dominance is slowly creeping up. I don't think that the altcoin market or investors are ready to allocate to the altcoin space yet. Let's see Bitcoin at 110,000 and higher. And I think those animal spirits will come back, and people will start slinging at money at any sort of shitcoin out there on the street, and we'll participate in that as well. But yeah, my bullishness is more predicated on Bitcoin responding positively to a change in expectations of fiat money creation, from now into the end of the year.
And you mentioned a couple of things here, like QE is obviously like a big part of that, and Powell signaled that in the last Fed meeting. We're not going to have another Fed meeting where he may or may not cut rates, for maybe a month to a month and a half. You mentioned the strategic leverage ratio that he may issue an exemption. Is that something that he can issue between Fed meetings, or do we have to wait for the next Fed meeting to get a word on that?
I mean, he can do whatever he wants, right? What happened in what the bank term funding program was an emergency meeting on a Sunday night, and him and Yellen issued that statement on how they're going to print $4 trillion, right? So if the circumstances warrant an emergency change in policy, they'll do it. I think that's the point, right? So if this tariff thing kicks off and S&P is down 40% or something crazy, right, and some TradFi guy is about to go bankrupt, and the Fed needs to step in and do something, they'll do it intra meeting. So I don't think people need to be so beholden to these meetings. But absent that, then the next meeting's in May, and I expect there'll be further clarification on how they view sort of the tapering of QT, what they're going to do about the roll-off of mortgage-backed securities in addition to treasuries, what they're going to do about the roll-off of mortgage-backed securities in addition to treasuries, and then what they think about the inflationary aspects of the tariffs, assuming that they continue and they're not rolled back because Trump makes a deal with XYZ different nation.
Got it. I got one more macro question, and then maybe we'll put a ribbon on it with a final stablecoin thing, which is, and the macro one is, essentially, you've been writing a lot about, and generally through the framing of like, is something positive for a liquidity injection? Is it net new liquidity to the system, or is it net subtractive of liquidity? And one thing that's looming besides the tariffs, besides Doge and Elon cutting, is this like $10 trillion of treasuries that were issued at the end of Biden's term to try to pump the market, and are now need to get rolled over. So when we refinance that $10 trillion, $9 or $10 trillion of debt, is that positive or negative to the state of liquidity in the system?
It's neither, right? It's sort of net neutral. They have to do it. The New York government is not going to default on their obligation. The question is, at what rate are they going to do it? If the rate is so high, do they need to have help from other agencies, the Fed or the banking system, to buy more treasuries to get the rate down? So when they refinance, it's not at a higher rate. So right now, the weighted average rate on treasuries is like 3.3%. And what's the 10-year now? I don't know, like 4.2 or 4.1, whatever. Yeah, something like that, right? So if they refinance the entire debt load today, they would actually increase the interest expense, which is not good for the deficit and the plans that Trump and Besson have for the economy, which goes to tell you that something needs to happen. Either foreigners need to buy more treasuries, the Fed needs to print money, or the banking system needs to buy them. Just one of those three entities needs to do something. And so what are the policy options that are available to them to influence somebody to buy these things at negative real rates, in my opinion?
Got it. And generally, like, question to everyone here, like, right now, the liquidity injection, like, money is pretty much created at like the top of the system and then tends to somewhat flow down, like get loaned out and re-originated and extended. And right now, stable coins are somewhere towards the bottom of that list, like the issuance of stable coins. Like, even if, BlackRock is still relatively high, but towards the bottom in that general hierarchy. Is there a world in which, like, stable coins could move higher up that hierarchy and we could see some larger institutions in the grand scheme of things issue stable coins on chain?
Maybe like a bank issuing their own form of dollar stablecoin on chain or something like that.
Yeah, like World Liberty Finance said they're going to issue. Wyoming said they're going to issue their own stablecoin. Like, whether it's state or national sponsored or Federal Reserve sponsored, like how could that look? What is there any possibility or reality to that?
Definitely think it's a possibility. I think I'm just slightly more bearish on their ability to take entities that sit outside of crypto to push stablecoins and like make headway in terms of grabbing share within crypto native venues, if that makes sense. So I think PayPal here is like the canonical example where you can actually think of PayPal's existing product as basically just being like a private blockchain where they're just moving PYUSD within their own like accounting system. That's all it is. And I think, they've done actually a pretty good job, I think, of growing to the size that they are. But at the scale that there are now, it's like less than 100th of the size of Tether. They found how difficult it actually is to integrate into the moats that people have built up within crypto native venues. So I think that people can go build their own stablecoins. I think that thousands of entities are going to go try do it, but they're just going to be used within their own sort of closed loop system, if that makes sense, rather than penetrating within crypto. And the real reason for that is like market structure reasons, which people don't understand, and I didn't even fully understand before I started Ethena, which is you'll never like unseat Tether until every centralized exchange that exists right now and crypto goes bankrupt, because every single trading pair on Binance, which is the most liquid, is denominated in USDT. And so no one gives a shit if you're paying them 4% T-bill yield when a market maker or an HFT entity is trading in and out of the BTC pair with USDT and like saving a basis point every time that they do it. So that's really like the moat, which is like the most liquid. And there's no other real axes for you to compete, right? You have to be a dollar, you have to be liquid, and you'll never be more liquid than Tether, or you pay more yield. And that's like the only way that you can think of competing within this market. And that's kind of the view that Ethena took, which is we'll never win those first two categories, but we can sort of have a real shot at the third one, and we can try to sort of create a wedge over there. So I'm actually extremely bearish on anyone's ability to actually compete with Tether. And I think if you're funding or starting a new stablecoin issuer now that's just backed by T-bills, I think it's just a colossal like waste of your time, energy, and money, and I would recommend against that. Yeah.
But I think they'll try. I mean, I think today we even heard the CEO of Bank of America saying that they would issue a stable coin like as soon as it was legal to do so. And it's at least something they're going to, in my opinion, from the discussions we're having with large financial institutions, that everyone's at least thinking about. I mean, if Bank of America say they're going to do it, everyone else is at least thinking about it. And for them, it makes sense, I guess, for a lot of these accounts, right? Because you could just do it cheaper. It's a better UX. You already see kind of users, especially in America, going to other alternatives like Venmo for payments, and that's just business they're losing out on. So it's something I think that they're going to try. Whether or not they have a good shot at doing it for the reasons Guy said, I think is a different question. But there's what's in the news and what we're hearing, and I think everybody has some type of stablecoin strategy internally that they want to take a shot at, because if you win it, it really is the holy grail.
I think it's a very America thing, right? Okay, it'd be great for Americans who have a cheaper way and a more convenient way to send dollars around, but
Yeah.
again, that's not Tether's bread and butter. Tether's bread and butter is in Shanghai and Hong Kong and Buenos Aires and other places around. They don't give a fuck if it's a JP Morgan or Bank of America. They can't use it anyways. And so it's great for America, and Americans will have a cheaper and a greater alternatives if there's stable coins running around, but I don't think that's going to alter the crypto and like non-US sort of landscape in terms of how digital dollars are moved around.
And it's also not net positive for liquidity conditions unless it exits that closed loop system.
Well, they're not. It's still a back thing, right? It's not like they're just creating. If there was a loan that they were creating to create the stablecoin, there's some sort of issuance of credit to do it. That's fine, but it's really not. It's just okay. Well, you were using Venmo, now you're using JP Morgan coin. Whoop-de-fucking-do. Who cares? It doesn't really impact us one way or the other.
Yeah,
or like
save a few dollars.
SLR exemption, like fractional reserves for stablecoins.
Well, the SLR exemption is basically just allows a bank to buy a treasury without having to put any equity capital behind it. It has nothing to do with stable coins. And so the stable coin and SLR are kind of two distinctly different things in terms of what it means for a bank. If the bank has an SLR exemption, then they basically can buy a treasury. It doesn't matter what the price is because they have infinite profitability. Even if the 10-year yield is 1% versus 5% now, I have no capital charge. So I can just buy as many treasuries as I want, and I create credit to do it. And so therefore my profitability goes up. And if the rates rise and the bonds go down, then I guess put them in the held to maturity bucket, and then I guess close my eyes and don't see the losses anymore. And that's what will happen.
I did see on that point you're making a very interesting research piece last week, which is like, what happens if all bank deposits in America left banks and went into stablecoins? And like, that's actually a very scary question, because obviously everything kind of works on credit, and the whole fractional reserve system requires there to actually be deposits in these commercial banks. And it's not the same when a deposit leaves a bank, which can be lent out, hundreds of times afterwards, and goes into something that's backed one-to-one within a stablecoin. So it's actually extremely dangerous for like the normal functioning of like credit within the US system if a significant amount of bank deposits left into something which looks and feels a bit like a yield-bearing stablecoin.
Which is why the Fed has denied any. Yeah. They call it I forgot the term. A bank that doesn't do lending. So a bank that just takes the deposits and whatever it's called. Caitlin Long tried to get one passed, but they don't want it to happen because it is fundamentally detrimental to how fractional reserve banking works. If you have people who create essentially a bank, which is a stable coin that doesn't do any lending and just takes deposits and pays a yield or doesn't pay a yield.
Yeah, and that was a big part of the Stable Act that is getting pushed through, I think, this month or later in May. It was pushing back against that aspect because of exactly this problem. I don't know if you guys have paid much attention to kind of what's happening there, but I know that Paula was in DC trying to kind of push for Tether there and kind of get onto the right side of the book. It seems like it's going to be a net positive for stablecoins, but it seems a bit more favorable to USDC than to Tether. But to Arthur's point, I don't think Tether really cares.
It doesn't really matter. It's an American thing. And stablecoins are not for Americans. Stablecoins are for everyone else who wants a dollar bank account but can't get one. Americans can get a dollar bank account. Stablecoin Act just makes it cheaper. And maybe it's a few dollars less a month that you pay to do the transfers. And that's great for the voting constituency. But I think for crypto traders, whether it's the Genius Act and some other act, I haven't read either one of them. It doesn't really matter. Yield or no yield, who cares, right? It's a thing for Americans to help them save money on transferring dollars within their system. It's not going to impact you.
So Andy mentioned this barbell of like speculation on one side and like payments on the other side. Are stablecoins not also a mechanism for leverage? And if we can use them to extend credit further, are we able to use stablecoins almost as a mechanism to extend credit and further leverage the system? Is that not also a use case?
Well, then who takes the loss, right? The great thing about being a fractional reserve bank is that when you fuck it up, your national government bails you out. So it doesn't matter how bad you are at originating loans in your domestic fiat currency. When you fuck up, and you will fuck up because you're a profit-seeking entity and you want to make more money and take more risk, then you get bailed out and they just print more money and plug your hole. But if I'm a private stablecoin issuer and I'm lending out money, however I'm lending out money, and I go bust, no one's bailing me out. I just lose money. So I don't think there's going to be net credit extended in the reckless sort of way that what you're hoping, which generates bags to be pumped because there's all this stablecoin credit running around.
You're hoping too,
not
Arthur?
everyone-
No.
No, the Fed does that for me. I don't need the Fed, the BOJ. I don't need.
If it's a public issued stablecoin by the state of Wyoming, then maybe the Fed will bail them out.
Maybe.
Gentlemen, it's been an absolute pleasure. Guy, congrats on the great work with Ethena. Would love to do a more technical conversation with you and the CTO as you guys roll things out. I know that we didn't get to touch on it too much, but super excited to see more there. Omer, keep up the great work on keeping all of our bags alive on chain. I've been a victim of many smart contract / just random DeFi shenanigans, so appreciate the work that you guys do. And as always, Arthur, it's a pleasure. So, guys, great conversation.
Thank you.
Guys.
This was fun. Thanks, guys.
Thanks, guys.